Hey everybody, my name is Brendan from thestocktunes.com, and today I want to talk about 3 stocks that I'm watching for the next week. And those 3 stocks are Palantir Stock, ticker symbol PLTR, Nio Stock, ticker symbol NIO, and finally Nvidia Stock, ticker symbol NVDA. So now let's get started. So let's first start off by talking about Palantir, the data analytics company. The reason why I'm watching the stock this week is because if we look at the stock chart, we see that we are at a long-term support level here around the $22 to $23 range. So next week, what I'm looking for is Palantir to drop slightly below this range, maybe below $22, so that I can play a pop back up to the $30 resistance level that we've hit a few times in the past. But remember, this is just a technical chart analysis. As an investor, you should also consider the fundamentals of the company that you are investing in. So quickly, if we take a look at Palantir's most recent earnings report, we actually see fantastic revenue growth year over year, with this being the most recent quarter ending on December 31st, 2020. But to me, that's not even the most impressive thing about Palantir. To me, what I like to see more than revenue growth is profit margins. And as we can see here, if we do the math, our profit margins are growing from 67% last year to 78% this year. And that is absolutely phenomenal. We see that because we are decreasing our cost of revenues year over year, but increasing our revenues year over year, we see that we are able to capture more of these revenues into our gross profits here. So as an investor, that is definitely what I like to see. However, unfortunately, the music doesn't end there for Palantir. If we keep looking down at the earnings report, if we look into the operating expenses block here, we really see that total operating expenses are growing year over year. If we see what's going on in this total operating expenses, the sales and marketing, research and development, and general and administrative, we see that the distribution of increased spending is really on sales and marketing as well as general and administrative. And that is not what I like to see as an investor. So yes, some of this money is going to acquire new customers, which is good for the business. But I also think that a lot of this money is probably being spent on corporate trips to Hawaii or team building events like laser tag, which to me is not pushing the business forward. Also, the last thing I want to point out is Palantir's actual business. Palantir does a lot of business with the United States government and has been in some controversy in the past. If you are a political individual, you may want to do research on Palantir's government and private contracts before investing in it. Again, this is not a political show, so I'm not going to go into it, but their business can be controversial and you may like it or you may not like it. But the main point is that you should always be aware of exactly what you are investing in and how that relates to your morals. Palantir is an extremely interesting company, so if you guys want a more in-depth review of Palantir, let me know in the comments below. But because of time, we now have to move on to another very interesting stock, which is Nio. So the next stock that I'm watching this week will be Nio. If we take a look at Nio's trading charts here, we see that we are actually in a very precarious spot. We are at a support level between a couple major trading ranges. We see that the nearest support level is made by these candles over here around the $39 and $40 level, and the nearest resistance level is made by the tops of these candles over here around the $50 level over here. From those levels, we see that we have about a 10% downside from where we are right now to a 20% upside, and that is a risk reward that I like to see in stocks that I'm looking to trade. I am also long Nio, so I don't mind holding it for a year or two either, which definitely makes Nio a good candidate for a short-term trade. That's because I don't mind if I get burned in the short term. That said, the short-term trade is a little bit risky because if we look, this is where we had our interest rate scare. And if you remember, when we had the interest rate scare a week or so ago, we really fell into a pit of despair here. So I do think that interest rates can still go higher. We are only at around a 1.75% yield on the 10-year bonds. So because of that, I would not be surprised if Nio falls down here again. This is why I held off buying Nio stock last week, because I want to wait and see if Nio goes down below 40 again. If it does, then I would probably be adding to my long Nio position as well as starting a trading position. But again, this is a technical analysis. For me, fundamental analysis and macroeconomic analysis is important for a long-term position. So if we transition to Nio's most recent earnings report here, we will see that quarter over quarter, we are seeing fantastic acceleration of growth in terms of vehicle sales and services, as well as revenues, with revenues growing by 46% quarter over quarter and a whopping 133% year over year. Furthermore, and again, something that I think is more important than pure revenue growth is gross margins growth rate. So if we look at the gross margins of Nio here, we see that we are growing our gross profit margins by 430 basis points quarter over quarter and a really impressive 2,610 basis points year over year. Basically, year over year, Nio is improving their profit margins by 26 absolute percentage points. Again, this is exactly what you want to see as an investor, and this is definitely exciting. These are just gross margins, which is different from operating margins. If we take a look at how we are improving operating margins by counting in the operating expenses, we see that the loss of operations here is also decreasing quarter over quarter by 1.5 relative percentage points and 67% respectively. Again, exactly what I want to see, because that means that we are on the way to profitability. We are cutting our loss from operations down by 67% year over year. So even though this is a positive, we are slowing down the loss from operations. This is actually bringing us to the downside of Nio's fundamentals. Even though we are decreasing our loss from operations dramatically, we are still operating at a net loss here. This is definitely not end of the world stuff here for Nio. A lot of growth companies are willing to operate at a loss if they can capture a large market share, grow their business fast, and be profitable in the future. However, the risk that you carry with Nio is that Nio does not become profitable or that its growth rate slows. The growth rate is really one of the only things that allows me to justify Nio's pretty rich valuation. There are more things that I want to dive into, like the total addressable market of EVs, so let me know in the comments if you want to see a deeper dive into Nio again. But because of time, we need to move on to our next company, which is a favorite holding of mine, and that company is Nvidia. So the third company that I'm watching closely this week is one of my favorite holdings, Nvidia. If we look at the trading charts here, we can see that we are at a very long-term support level, around the $515 level. If we look, Nvidia has been pretty range-bound around the $515 level and around the $550 level. So the reason why I'm holding off on adding more to my Nvidia position, even though we are at the bottom of this trading range, is because look at a couple times where we knifed through this trading range. We knifed through the range a couple times in the past, once over here, but the point that I want to make in the Nvidia section of the video here is this knife through of the range when a week or so ago we had the scare of interest rates. I'm still holding some cash earmarked for Nvidia on the sidelines in case we get another interest rate scare next week. If we do, I would want to buy some more and average my cost basis down. But again, because I am long Nvidia, I don't just like Nvidia because of the technicals, I also really like Nvidia because of the fundamentals. Looking at the most recent earnings report here, I am seeing fantastic growth in revenues year over year, with this being the most recent quarter ending on January 31st, 2021. Nvidia is growing revenues up over 53% year over year. For a huge company, that is very impressive to say the least. This growth has been really helped by data centers and gaming, and I think that those two are the main sectors that will be really pushing Nvidia upwards in the future. The whole gaming industry will be changing rapidly in the next few years, and in order to power that, the gaming industry needs chips and graphics cards like Nvidia's. The only downside that I see for Nvidia at the moment is valuation. We are sitting at a very pretty expensive price to earnings ratio here, around 74. This is compared to AMD's price to earnings around 38 and Qualcomm's price to earnings around 22. We are certainly trading expensive compared to its peers, and this could be exploited by interest rate scares in the following weeks. Again, I do have a lot more stuff to say on Nvidia, like the ARM deal or more about Jensen Huang, the CEO, but again, because of time, this is where we will end today. So that was my review on Palantir, Nio, and Nvidia. Let me know what you thought about this type of content. If you like seeing more stocks in one video, I will probably make this a weekly series. So let me know in the comment section down below. If you like the video, please like the video. If you haven't subscribed yet, please subscribe. And as always, thanks for watching, and I hope you have a great day.